Hey everybody, welcome back. We've learned a thing or two about technical analysis. We have a lot more to come. We have some very specific strategies that we're going to use. Now, in some of these strategies, we're going to combine technical analysis with fundamental analysis, as we discussed earlier. So we need to cover some points on fundamental analysis so that we'll understand exactly what we're trying to construct. Now, one of the things that I want to introduce to you here, as far as a concept, is valuation. What is a company worth? There are some very smart investors out there like Warren Buffett. They have very specific rules for measuring the value of a company. These rules are fairly simple and they can tell us if a company is overvalued or undervalued. Traders use these valuation methods to determine what to buy, and then they can use technical analysis to determine when to buy them. And the same thing is true with selling short. We use these methods to determine if something is overvalued, and then we use our technical analysis knowledge to actually sell that stock short. Now, when it comes to valuation, the first thing I want to introduce to you is a very, very simple concept called market capitalization, or market cap. It's the share price times the number of shares outstanding. A stock's market cap is the cost of buying all the available shares on the market. So, if a stock is trading at $30 a share and there are 20 million shares outstanding, 20 million times 30 is 600 million. So we could say that that stock has a market cap of 600 million, and that makes it a small cap stock. We're going to try to stay out of the small cap area for reasons that will become apparent as we continue. Now, the following represent general definitions. There are no official definitions for capitalization, but in general, small cap is under $1 billion market cap. Mid cap is between a $1 billion and a $10 billion market cap. Large cap is anything over $10 billion market cap, and the term micro cap is used to describe a stock that's under 300 million in market cap. So generally, larger cap stocks are considered safer, and that's really where we're going to focus. But really, we need to determine the real value of the company, not just the market cap. So it's one thing to understand the market cap, but wait, what if that company has debts? Or what if they're sitting on a big pile of cash? What if both things are true? Maybe they have a lot of debt and a lot of cash. So doesn't that matter? Of course it does. So if we buy this company, we'll also be buying the debts and the cash of the company. How are we going to account for this? Simple. Something called enterprise value. The enterprise value of a stock is simply the market cap plus the debts minus the cash. It gives a very clear picture of the company's true value. And ideally, you want a stock that has an enterprise value that is lower than the market cap. Now, let's take a look at an example. Which of these two stocks would you rather own? We have a stock with a market cap of about $100 billion, but the enterprise value is less than $70 billion. That means that stock is cash rich. That company, I should say, is cash rich. Beneath that, we have a stock with a market cap of $428 million, but an enterprise value of $700 million. Now think about this for a minute. If a company has a lot of cash, that lowers their enterprise value. If they have a lot of debt, that raises their enterprise value. So the first stock, the one up top, actually has a better valuation based on its enterprise value. The two stocks that we're looking at here are Cisco Systems on top and Ruby Tuesday, which is a restaurant chain, on the bottom. Now the stock on top, Cisco, has a mountain of cash, and that's why the enterprise value is much lower than the market cap. In fact, they have enough cash lying around to buy Ruby Tuesday dozens of times over if they so desired. On the other hand, Ruby Tuesday has a lot of debt. That's why their enterprise value is higher than their market cap. Now, we can take a look using websites like ycharts.com at a company's cash and how it's growing. This is a little shot from YCharts of Cisco's cash pile and how it's been growing over time. So when you buy shares of Cisco, you're buying a big chunk of cash. And theoretically, that helps the company. If they hit hard times, that cash should act as a cushion that'll prevent it from falling too far too quickly. Here's another concept, price-earnings ratio, the PE ratio. This helps determine if a company is overvalued or undervalued. How do we figure out the PE ratio? It's the share price divided by the earnings per share. If XYZ is trading at $50 a share and they earn $5 a share over the past 12 months, then we say it has a PE ratio of 10, right? We can also say that XYZ is trading at 10 times earnings TTM, trailing 12 months. Whenever we talk about PE ratio, unless it's otherwise specified, you're talking about trailing 12 months. Now the problem with TTM is that it's like looking in a rearview mirror. We might be more concerned with what the company is going to earn in the future as opposed to the last 12 months. So the forward PE is the price divided by the expected earnings per share. Stocks that have a very high forward PE have very high expectations. We also say that they are priced for perfection. That means if the company makes a mistake, if they miss earnings, if something else happens that's not expected, those shares can really get slammed because the expectations for growth are so high and because the stock has such a high valuation, those shares can be dangerous. Now, out of these two, which is cheaper based on the forward PE? We have a stock here trading at 30 times its expected earnings, and we have another one trading at only 12 times its expected earnings. Obviously, the stock on the bottom has a lower forward PE, so we would say that it's cheaper based on its expected earnings. Now, that stock on top, by the way, was Facebook after the share price was cut in half. So, people will look at a stock and they'll say, oh, it's down so much, it's cheap. No, not necessarily, right? You're just looking at the price. You might be fooled into thinking that a stock is cheap. But a stock that's been cut in half can still be overvalued. And that usually means it's either going to go lower or it could have a very hard time regaining lost ground. Okay, so despite the fact that that stock was cut in half, it was still an expensive stock at $19 a share just a few months after it had its IPO at $38 per share. The stock on the bottom was Apple after that price of Apple had increased sevenfold in 3.5 years. So one stock had gone way down and one stock had gone way up, and what I'm telling you is the one that went down is still the expensive, overvalued stock compared to the one that's already gone up sevenfold. How could Apple still be considered inexpensive after climbing from $90 a share to $600 a share in just 3.5 years? How do they do that? Well, if they're growing the earnings, right, then the stock price is justified. The stock was going up at a tremendous rate, but the stock was not overvalued because the earnings, the money was there behind it to justify that price. And here you can see Apple growing their earnings at a torrid pace. That's why the stock can go up so much and still be considered inexpensive. Now, speaking of Apple, let's compare apples to apples, because this brings up an interesting point. Not all companies or industries grow at the same pace, right? We don't expect paper stocks to grow at the same rate as semiconductor stocks, okay? They're very different industries. So some companies and some industries deserve a higher forward PE ratio than others because they have higher expectations. They're expected to grow faster. So how do we compare companies that have different growth rates? Simple. We have something called the PEG ratio. PEG ratio is simply the forward PE ratio divided by the expected growth rate. If XYZ stock has a forward PE of 20 and it's growing earnings at 20%, we say that XYZ has a PEG ratio of 1. And a PEG ratio of 1 is considered fairly valued. We say, okay, that's right about where it should be. It's growing at 20%, is trading with a 20 forward PE. But stocks that have a PEG ratio above 1 are considered expensive. And stocks that have a PEG ratio of less than 1 are considered inexpensive. So let's take a look at two stocks here. Which one is cheaper? The one on top has a PEG ratio of just 0.66. So it's trading at a discount to its growth rate. The stock on the bottom has a PEG ratio of 1.5. That is actually trading at a premium to its growth rate. And by the way, what is the expected growth rate for both stocks is something you can figure out just by looking at the numbers here. They're actually both growing at about 20%, approximately. So it's interesting how one stock gets a much lower valuation and one gets a much higher valuation for the very same growth rate. And this just goes to show you that everything isn't always priced into the market, everything isn't always logical, but we can use these little things to gain an edge. Speaking of an edge, what are we looking for? We're looking for growth at a reasonable price. We want stocks that are growing, but we don't want to overpay for them. And growth at a reasonable price, or GARP, is an important concept. This was popularized by Peter Lynch, who was a legendary fund manager, because the growth rate is important, but how much you pay for that growth rate is even more important. We want to get a discount. Now, GARP investors look for stocks that are growing quickly, but have inexpensive valuations. So, for example, if XYZ is growing at greater than 20%, but has a PEG ratio of only 0.6, we'd say, hey, we can buy some good growth here and we can get it cheap. Here's another concept, price to sales ratio. You already understand price earnings. What about price to sales? This method of valuation is used to compare companies that have similar businesses. And it's also very useful to compare companies when one of the companies or both have no earnings, and that happens. Some companies don't have earnings, so they don't have a PE ratio. So price to sales, how do we come up with that? That's the market cap divided by the company's sales for the TTM, the trailing 12 months. And of course, just like PE ratio, price sales ratio, you prefer a lower number. Now, here's two examples. We have a company, Zynga, which has been crushed, falling from $15 a share to $3 a share. A lot of people are going to look at that and say, oh, this stock is cheap, it's only $3. But the price to sales ratio, even after the stock got smashed down, is 1.79. And that's a lot higher than its competitor, Electronic Arts. Electronic Arts stock had moved up from $11 to $14. So while Zynga was falling, EA was going up, but EA still had the cheaper valuation based on this metric. EA still cheaper than Zynga based on price to sales ratio. And by the way, that low valuation sometimes attracts buyouts and things of that nature. So when you're buying companies that are undervalued, just remember private equity is looking at that too, and they might say, you know, we can take this company private, let's buy them out for X amount per share. Because why? Because it's cheap. All right? Now, look at this chart. This is from ycharts.com, which is a great website, provides you with a lot of information. Zynga is the orange line, EA is the blue line, and what you're seeing is the price-sales ratio of Zynga coming down to meet the price-sales ratio of EA. They're not quite even yet. I suspect that they will be at some point. Here's another one, price-to-book ratio. What's the book ratio? It's simple. It's the breakup value of a company. So if your company sells everything it owns and pays off all its bills, how much is left over? What's left? That's the book value of a company. Okay, so stocks often trade at a discount to their book value. And how do we determine the price to book ratio? It's the market cap divided by the book value. Okay, this is great for comparing companies within a sector. And some sectors do have a tendency to trade at a low book value. So if you see that there's one particular sector and all the names in that sector are trading at a discount to book value, it could be that that sector is out of favor. So that could tell you something not just about the stock, but about the sector as well. Here are two bank stocks. One is trading at a discount to its book ratio, and the other is trading at a premium to its book. The first stock is cheaper based on valuation. It could also mean that the second bank deserves a higher valuation. Maybe their mix of business is a little bit different. So always check up on the news. All right. And by the way, MRQ, what does that mean? Most recent quarter. So you're looking at the price to book for both of these stocks for the most recent quarter. Here's another one, price to cash flow. It's just the market cap divided by the operating cash flow. This is great for analyzing international companies. Companies that are based outside of the U.S. are very often traded on U.S. exchanges under what we call ADRs, American Depository Receipts. But keep something in mind, right? If you're comparing price-earnings ratios of stocks from different countries, just remember, accounting laws vary from one country to another, so that price-earnings ratio might not make sense because the rules might be different in a different country. But cash cannot be manipulated in the same way that earnings can be. Now, naturally, just like these other similar metrics, the lower number is better. So, you want a price to cash flow of 15 to 20 or less. And you can get that information for free very easily on websites like Yahoo Finance. Here's a cash flow statement for a stock on Yahoo Finance. So all this information is really very easy to obtain. Here's another concept, EBITDA, earnings before interest, taxes, depreciation, and amortization. This determines the operational profitability of a business. But keep in mind, it's not based on generally accepted accounting principles. What does that mean? Companies can include or exclude certain items at their discretion. And the people in this business who are the real detectives, those really good analysts, look at EBITDA and they say, wow, this company took something out of there. Why? Were they trying to hide something? Okay, so little tricks like that. That's a little bit more advanced. We're not going to get into that this time around. But just understand that this is the earnings of the company before interest, before taxes, before depreciation, before amortization. And how do we use that? Right? Here you can see the EBITDA is trending higher on a stock. This is actually a very useful indicator when compared to the enterprise value. Now, you already understand the enterprise value. We talked about that at the beginning of this segment. Enterprise value is the market cap plus the debt minus the cash. EBITDA describes how much cash the business can generate, regardless of the capital structure or the financing or the debt, etc. If enterprise value, the ratio of the enterprise value is less than 5 times EBITDA, that company could be a takeover target. And those companies, of course, have a tendency to pop sometimes. So here you're looking at a company that has an enterprise value to EBITDA of less than 2. That's very, very cheap company. It's probably a takeover candidate unless there's something really wrong with it. Just keep in mind, sometimes stocks are cheap because they're bargains. Other times they're cheap because they're damaged. It's up to you and me to do our homework, read up on the news, look up what's going on with the stock so that we really know what's going on.